If I had to start investing today from zero, here's exactly what I'd do. I've been a hedge fund manager for years. Actually, it was during the worst time ever. It was during the 2000, 2003 bear market. So I have some experience what works and doesn't. So if you've saved up a little extra cash and you're thinking, I should probably start investing, you're not alone. It doesn't matter you're in your 20s, 30s, 40s, whatever. But when you're new, the investing world can feel like very confusing, like almost like a maze. You also have this FOMO, fear of missing out syndrome. Many of your friends probably have chased Nvidia or Palantir and made small fortunes because they've gone up. However, markets just don't go up all the time. They go down at times, and they can be really painful. So you need a plan. So in this video, I'm breaking down exactly how I would start investing, let's say now in 2025, step by step, simplest way possible. And I'm covering 5 parts. So feel free to jump around if you need. Part 1 is why investing is essential, what beginners should invest in, when and how much to invest, a live walkthrough of buying a stock or an ETF, and then number 5 is a strategy, actually how to grow wealth over the long term. That's really our goal. So let's dive in here. Okay? Had to take my breath. We have to figure. So why should you be investing? That's the first question. And the biggest reason anyone should be investing is rather simple. The thing that works against us is inflation. And you want your money to work for you instead of you work for your money. So if you just sit on your money, let's say in a savings account, under your mattress, which no one does, it will slowly lose value just because of inflation. Inflation will eat you up. This means that the buying power of your money is going down. Things are getting more expensive. That, whatever you want to call it, Starbucks, coffee, the hamburger, you name it. So in order to protect yourself and your family and to grow money faster than inflation, really there's only one way to do it, and that's investing. And that's the easiest way to do it, even though it's not easy. We're the hard part. So you need to learn the proper mindset. When you invest, your money grows in 2 major ways. One is the growth of the company, or let's say a basket, like in the ETF you invest in. And let's say if you talk about companies, make it simple. Let's say you buy Coca-Cola stock. You literally own a piece of Coca-Cola. So every time someone drinks a Coke anywhere in the world or one of their products, even if it's water, you just made some money, even though it's like micro pennies, but they add up. So the idea is that you have compound interest, which is the famous 8th wonder of the world. Compound interest means your money earns interest on top of interest, and so on and so on and so on. For example, imagine saving $1,000 every month, or even 100, let's say. On average, these instruments average over time about 8%. So over 7 years, you'd hit, if you did the 1,000 every month, would you have 100,000? The 100,000 closer to 4 years. The next one comes after 3 years. And eventually, believe it or not, you will have $1 million. It's like the proverbial buy right and sit tight, or just buy and sit and just let it compound. It's a snowball effect. That's how compound interest really works. And add in the fact, another idea is the aristocratic blue chip companies that raise their dividends yearly, or have raised them yearly. I mean, anything can happen. I'm talking about companies that have been around for 50, 60, 70 years that have raised their dividends. And this is how Warren Buffett has made so much money. He hardly ever sells. The shares compound and the dividends compound as well. The idea is letting time work for you. Again, you're in your 20s, you're in your 30s. You got a long runway. We use Warren Buffett. He didn't get scared out of the market because there's always going to be bear markets. He knows that's part of the game. It's accepting the fact, like winter, there's going to be snow. And the markets, there'll always be bear markets. And the markets come back. And these aristocratic blue chips, I mean, anything can happen, but can you see Coca-Cola going out of business? Johnson & Johnson? I find it pretty hard to believe, or Exxon. So what should you invest in? A lot of beginners make a classic mistake. They'll go after the mime stocks, or they'll go after the stocks that have performed so well recently, what worked in the past. And the proverbial past performance is not indicative of future performance. So the companies on top today, it could be anything. It could be Microsoft. It could be NVIDIA. It could be Palantir. Might not stay on the top. If you look at the internet bubble, 2000 to 2003, the internet bubble, these stocks fell 78%, and some of them never came back. How many of you remember Sun Microsystems, Cisco? Cisco's still around, but they're like today's, fab stocks, the Googles, the Microsofts, and everything else. But the boring stocks and the boring ETF, Spider and QQQ, Coca-Cola, Colgate, are boring compounders. They're going to survive, or they stand the propensity to survive and compound money. Just another example. I'm dating myself. I'm 63 here. Nokia dominated the smartphone phone market in 2010, collapsed. The biggest companies in the 80s, even before, gone. So you got to look at companies that you got to say, will they be around for the next 20, 30, 40 years? We're not looking for the next big thing. I'm not looking for NVIDIA. I'm looking to compound money over long periods of time. Because if you're going to buy some hot stock or mime, you're basically putting all your eggs in a basket. And when those companies, or if they crash, your money crashes with it. And I'm too old for that, and I don't want it. And your goal is to compound money over long periods of time. And that's why I'll also stress the idea of an index fund. Every month, allocate a small amount of your paycheck. I don't care if it's a bull market, bear market, just put in, if it's $100, $1,000, whatever, let it compound. Do not take it out. Don't get spooked. And the idea with the index fund, you have diversity. You have, hundreds of shares, like the QQQ is 100. And then I would also potentially, everyone makes their own decisions, then I would look at the ideas of Johnson & Johnson, Coca-Cola, Colgate, Pepsi, Chevron, and then let the dividends compound. And then I'm not reinventing the wheel here. This is exactly what Warren Buffett has done. And even he suggests index funds or dividend high yielders. Just look at what he owns. So the idea is, with an index fund, unless you instantly own hundreds of companies one time, you set it and forget it approach. It lowers your risk, and it has the potential to build wealth over time. Even Warren Buffett said most people should invest in index funds. The only issue today in let's say the QQQs or even the Spiders, a lot of these stocks that are in there, there's a leaning towards the AI stocks, which at some point might have an issue. Anyway, anything can happen. So what's an index fund? Break it into a couple of words. An index is a group of companies. The S&P 500 has 500 of the largest companies. So the whole idea when you're buying an index, you're spreading across all kinds of companies, so you're not making that one-off bet that can blow up. And the same thing like with the tech. You can buy the QQQs, which is the top 100 stocks, and the tech companies. So again, like I'm saying, you're not betting on one winner. You're focusing your time on your life and also preparing yourself for the future by making a consistent allocation, bull market, bear market. And then when you get into, let's say, again, the Spiders, SPY, or the QQQ, these ETFs, the expense ratios are very, very small. And this allows you to compound money even greater. Even like the great index funds, they have fees that are like 0.05 up to 0.2, which is extremely low. So you don't need a money manager or anything else like that. And you just basically set it and forget it. And preferably at times when there's a bear market that you might even allocate more. So when should you start investing? You got to look at your own personal situation, because none of this is investment advice at all. But the thing is, you got to say to yourself, do you have high interest debt over 7%, like credit card debt? And if you do, you should pay that off. Because credit card debt, let's say 20%, is getting a guaranteed 20% return if you just pay it off. So the next thing you need to consider is, do you have an emergency fund? Because any job is not 100%. Anything can happen. You have a terrible economy, and all of a sudden you're out of a job. So you need to have an emergency fund. I'm very paranoid, so I would suggest a 1 year, which I think is better. And without this, otherwise you'd have a big problem if you have car payments, medical bills, job loss will force you to sell your investments at a bad time. So if you've paid down your credit cards and you have really no debt, so you should begin. And how much should beginners invest with? There's no minimum, even if it's $100. But do a small allocation of your salary every month. And then I'd also really suggest is just do it and forget about it. And don't look at the screen. Don't look at the gyrations of the stock market. Don't watch the news. Just be disciplined. If you can keep on putting in every month, you dollar cost average, and you're investing money that you don't need for a few years. And if you need the money for the next year, let's say for a down payment on a house or car, tuition, keep it in savings, because the market is unpredictable in the short term. You will have bumps, you will have drawdowns, you will have bear markets. So ideally, you want to buy and never sell an index fund of the market or these aristocratic blue chips as long as you don't have an immediate need for the money. So the next thing is, how do you do it? How do you actually buy a stock or an ETF, a fund? What do you do? So you also should have a retirement account, like a 401k. Make it simple, great tax benefits. But the thing is, you have to understand your money's locked in until 59 and a half. Brokerage account, flexible, withdraw at any time. If you withdraw it, you're going to be taxed. You're going to be taxed on your dividends. But you can open an account with Fidelity, Schwab, you name it. They all work fine. Your account is created. You connect your bank to it. Deposit any amount you want to start with. Again, like I said, it can be as little as $100. And you search for an index fund. I'd suggest index funds in the beginning. And it could be the SPY or the QQQ. And just start buying and do it dollar cost averaging every month. And then, you have a choice of a market order or a limit order, but make it simple. Keep things simple. The KISS principle. Keep it simple and stupid. Do a market order and just get started. That's really, really the key. Confirm the trade, boom, press. You're on your way to compounding wealth over the long term when you're 50, 40, 60, whatever. So ideally, I buy at the market and I let time work for me, and you're compounding money consistently. And there's going to be some really ugly periods. Don't kid yourself. There's going to be some really rough, challenging periods. I've lived through them. I lived through 87. I lived through the 90s, you name it. And they're always out there. So hang on one second. So if you're a beginner, you need long-term investing beats short-term trading every time. Because people panic during downturns. They sell at the wrong time. But if you zoom out, the market has always recovered and grown. And even if you bought right before the 2008 crash or the 2000 internet bubble, holding long-term, you still would have multiplied your money. Okay? Because the other thing, missing out of the just 10 best trading days over 10 years can slash your returns by more than half, simply because the biggest jumps often happen suddenly. In the worst times, when everyone thinks the market's going down, it's going to be a depression. The market jumps. So you have to stay invested. And that's why you don't want to be a day trader. Too much emotion, too much pressure. The idea of being a long-term investing over time, historically, has won. So there's another adage. During a bear market, which is going to happen, you want to buy right and sit tight. And the best time, believe it or not, is to buy during a bear market. And that's when I increase my allocation and I scale in at different increments. Let's say the market's down 25%. Most people are like panicking. But I'm going to increase my portfolio 25% into some, let's say, the aristocratic stocks, the Coca-Cola, the Pepsis, the Exxons. Because every time the market turns down further, I add a little bit more, and then I sit tight. So, again, just do a quick summation. I'd suggest initially, for anyone, this is just general advice, do an index fund initially, because you have a diversification. Get used to investing every month, so even small amounts every month. And then the idea is like you can do the spiders, the QQQs. There's also the SPLG, and it tracks the largest 500 companies. The expense ratio is 0.02. And you have stability, you have some growth. Then there's the Vanguard Growth ETF, VUG, which is a little bit more aggressive, focusing on faster growing companies. Their expense ratio is 0.05. It could be for younger investors who have maybe a higher risk tolerance, let's say, or there's like people like me, a 63-year-old and older, might consider the Schwab U.S. Dividend Equity, SCHD, which focuses on high-quality dividend companies, like I was saying about the aristocrats, with the expense ratio of 0.06. It's really, I mean, again, I'm not recommending anything, but it's passive income and looking for long-term stability. The next thing you need to be aware of, taxes. Guess what? If you sell, you're going to be liable for tax. That's another reason you don't want to sell. Warren Buffett really doesn't sell. He keeps things for decades. The only thing you are going to pay tax on your dividends. If you sell for a loss, you can deduct it. But the idea is, the other fact is, you're still going to pay tax even if you hold for over a year. You have the capital gains tax. I'm not an accountant, but the whole idea for a longer term investor is just don't sell. Buy quality companies, own pieces of those companies, and collect the dividends. So let me just do a quick summation. Investing now, 2025, could be one of the most powerful ways to grow your money and build wealth. I mean, people, they're always going to say there's going to be a bear market, it's going to be a depression. Nobody knows. And even if the market falls, you're going to keep on allocating every month. So you're going to dollar cost average. So there's 2 parts to this. The investing is only half the equation. The other half is managing yourself. Your emotions, your fear, your greed. So that's what I'm here to try to do. If you want to learn the perfect routine, I use a payday to stay on track financially. Click the video, join my group. I'm here to help and instill knowledge that I've gleaned over many, many years, and mistakes also. So I want to thank everyone for watching this video. And if you like what I'm saying, obviously, please subscribe.